Higher interest rates contributed to a 68% rise in net interest income over the prior year. Net interest income, as we can see in this table, increased by over $1 billion this year compared to last year. And the net interest margin, it is now more than 2 times higher than it was just 2 years ago. It is a good business environment to be in the brokerage business. We are going to walk through the 2023 annual report of Interactive Brokers. We know that our in-house AI is recommending this as a strong buy, but our job is to validate what is the fundamental reason behind the numbers. For a less intense financial analysis experience, I suggest skipping past the Gathering Facts chapter. Share with your friends, and let's dive in so that your wisdom can blossom. This video is intended for educational purposes. Opinions made by me or the Sage Seeds AI are not investment advice. Yes, elevated inflation and the tighter monetary policy that comes along with it have raised the attractiveness of the brokerage business without Interactive Brokers or other brokerages having to do much of anything different. The expectation that there would be a soft landing with lower interest rates in the near future has driven global economic markets higher despite the ongoing backdrop. Individual investors have been more engaged in 2023, breaking all sorts of all-time highs and records through their participation in the markets of a small number of technology stocks, futures, and yes, equity-based options. Options trading volumes have risen in lockstep with the regulations which have allowed shorter-dated options contracts to become substantially more liquid. Whereas 10 years ago, even 5 years ago, the idea of a zero delta option was unheard of. It would have been seen as completely not acceptable. Not only has it become acceptable, it has become fashionable to be trading zero delta options. Almost all of the growth is in selling individual investors options, while the volumes of stock and forex have declined very, very rapidly, 24% and 29% respectively. At first glance, that looks like a sort of cannibalization, and so we will need to keep an eye on it. There's no point selling more options if that money that is going towards buying options is coming from your customers reducing their purchases in other services. Currently, 81% of individual investors on Interactive Brokers reside outside of the US, essentially the only brokerage that offers itself with all available features in over 200 countries and territories. They're also one of the most balanced brokerages when it comes to prime services versus servicing individual or retail. 57% of customers are using institutional accounts. This is the hedge funds, the financial advisors, the prop trading firms. And so with an almost half and half business split down the middle between retail customers and institutional clients, Interactive Brokers has a wider product than most any other brokerage firm because most other brokerages choose to specialize. Interactive Brokers is doing both quite successfully. Let us not forget that between 2019 and 2020, something called the pandemic happened. The number of cleared customer trades more than doubled in a single year. Now, after reaching a peak in 2021, there have been declines both in 2022 and 2023, but keep in mind that 2023 just had more trades cleared than 2020, when 2020 itself was, by all accounts, an outstanding record-breaking year. 4 years into this does not seem like a pandemic pop. This is a new world in which people are trading at levels that no one could have anticipated just a few years ago. People gonna be trading. Interactive Brokers is getting more and more efficient at charging commissions. They are charging more in commissions this year, despite having less transaction volume than 2021, which was their peak year for transactions. It's not all a happy story because my eyes are noticing that execution fees, also employee compensation, both of these values are growing very, very quickly, certainly above trend. And the first year that transactions double, you can probably tell your employees that that might just be a pandemic pop. But 4 years in, you can easily imagine how employees are now gaining the upper hand, asking for those raises, demanding higher benefits. That's all probably fine and good. I'm sure they deserve it, but it's not immediately clear to me why they're spending about $150 $50 million more in executing that lower number of trades. We're going to have to dig in deeper. And this is where things start to get interesting, because Interactive Brokers has always claimed for decades now the lowest commissions of any other major brokerage due to their proprietary technology called IB Smart Routing. This is where instead of just submitting your order to an exchange like some other brokerages still do in this day and age, Interactive Brokers retains control of your order, continuously searching for the best available price and dynamically, keyword dynamically, rerouting even to the point of splitting up your order to hit the lowest execution and commission costs. Any person using a pro account can see exactly what I'm talking about by looking at the transaction cost analysis reports. At the same time, for the institution side, this might be less easy to see. A lot of this same proprietary technology does get used at the block trade desks. This is for large or complex orders. You get assigned people, a lot of it is automated, but you essentially get assigned a bot to execute your large orders and source liquidity. Probably the simplest way to summarize this is that they offer price discovery services. This is when you have an order so large that there isn't a quote already available. These are the two main ways that Interactive Brokers executes trades. Using their smart routing is kind of like an Expedia or a Booking.com for financial instruments. And in the block trade desk, we're going to build up the liquidity. We're going to source it. That's more like a travel agency. This is what I want. Figure out how to make it happen and let me know what the price is going to be. One of these two parts of the business is becoming less efficient very rapidly. All the financial statements are looking wonderful for Interactive Brokers. I mean, this is looking like a good stock, but this is a blemish. Their non-interest rate part of the business, their execution part of the business, their profit is actually lower because of some costs that I still don't quite understand yet. In a section titled Transaction Processing, Interactive Brokers explains that their market-making software, this is the block order desk, generates and disseminates to the exchanges and market centers a continuous stream of bid and offer quotes. When an order is executed, a trade record is written into the clearing system, where a chain of control pushes the trade into a final settlement. That's the part that only a brokerage can do. The main reason why we can't just trade amongst ourselves nearly as easily. After looking for a good long while, I think I finally found something that could explain where this increasing inefficiency could be coming from. The company's non-US domiciled subsidiaries have a functional currency that is not the US dollar. Because Interactive Brokers conducts business in many countries and many currencies, they operate based on a diversified basket of currencies. And just checking our understanding of what they do, this makes total sense. 80% of their customers are not in the US. They offer brokerage services for 200 countries/territories. They actively manage their global currency exposure by maintaining their equity in what is called the Globals basket. Here is actually just a copy and paste of what the Globals state of affairs is like. This is an ETF of sorts that just holds a basket of the major global currencies. What I want to point out to you a bit critically is that you'll notice that whenever you're having a basket of currencies, it's never a truly global basket like Interactive Brokers just said, because ultimately you're going to have an owner, and whatever currency the owner wants to receive is going to be the baseline for everything else. Even in this global basket, you'll notice that the FX rate changes for everything except the US dollar, which stays at 1, and the currency that is pegged to the US dollar, which is the Hong Kong dollar down here. Everything else, all the other floating currencies, are still floating. Now, does this help? I'm sure it helps that they own this. The idea being that if exchange rates were changing very, very rapidly in ways that are unfavorable to Interactive Brokers, Interactive Brokers has too many complex transactions internationally in order to immediately know whether a specific exchange rate going up or down is bad or good for them. In fact, that answer will more than likely change day to day, week by week. However, despite having some of its equity in global, about 25% of their equity is actually denominated not in global, but not in US dollars either, in non-US dollar currencies. 25% is quite high. The only thing that I'm pointing out is there is a noticeable lack of efficiency, a decreasing level of efficiency in their trade execution businesses, based on the notion that the cost of constantly hedging currencies would amount to more than the random impact of rate changes. Historically, hedging currencies has not been a top priority for Interactive Interactive Brokers. And so when Interactive Brokers tells us that the full effect of their currency diversification strategy appears in two places. Number one, as a component of other income. Number two, as other comprehensive income in the financial income statement. We can take them at their word, go to the income statement, go to the comprehensive income section, look at other comprehensive income and see that their big genius plan for diversifying their currency risk changed 30 million this year. Kind of cost them money last year, cost them a little bit of money the year before that. Whether it's positive or negative doesn't bother me that much. That's normal for this sort of hedging. But the absolute values here, 30 million, less than 50 million. Let's just scroll up and look at the revenue related to commissions of international trades. 1.36 billion. It's a little bit more than 30 million. Well, let's not be too harsh. Just look at the money they are making outside of the US. Now, this table does include both interest and non-interest income, but remember, for the last 3 years, their brilliant hedging strategy is having an impact of tens of millions of dollars. They've been making more or around $1 billion during those same 3 years just in international markets. That means that, unless I'm missing something obvious, in the best case, Interactive Brokers has actually been hedging their currency risk in a way that has a maybe 2% impact, really 1% or less of an impact. And despite their international revenue skyrocketing since the pandemic, despite them actively marketing since the pandemic with IBKR Global Trader, can't forget IBKR Global Analyst, despite starting to, for the first time ever, allowing white branding in which large financial service customers of Interactive Brokers can use Interactive Brokers without disclosing to their customers that they're using Interactive Brokers. That's called white branding. I want to get a sense of the effort, at least. And so in this little paragraph, we get enough information. Their entire strategy can be summarized as, instead of holding US dollars, they hold global ETFs. We're going to figure out how much they put into that by taking the $42 million that they made from a 0.41% increase in the value of their holdings. 42 million divided by 0.41% gives us about 10.2 billion in global holdings. So let's compare that to the balance sheet. Straight up US dollars is 3.7 billion. Cash for regulatory purposes, international regulatory purposes, I might add, is 28.8 billion. Securities segregated for regulatory purposes, again, international exposure, is 35.3 billion. In fact, scrolling down to the liabilities section, just the securities loan, so the value of what they have allowed their customers to sell short, is 11.3 billion. And so the 10.2 billion hedging your currency risk matters even less than accounting for what you're short selling or allowing your customers to short sell. What I'm pointing out here is that Interactive Brokers could not be doing more in order to invite global currency risk exposure. They have been very much using the last several years in order to become more globalized than they ever have been before. All their marketing even states that they are the global brokerage firm. 4 years into this new world order for them, it's not taking me a lot of effort to identify what I would characterize as a lack of respect for the global currency risk that they have been inviting at every single opportunity. They're not prioritizing taking it seriously. And in just 4 short years, this cost of execution, clearing, and distribution has to be getting impacted by the fact that they're doing more trades than ever where there's a different starting currency than an ending currency. People all over the world trading currencies in order to buy options and futures contracts, or let's say it even more directly, borrowing currency from Interactive Brokers. If those clients do get into trouble, that by definition means Interactive Brokers gets into trouble. Hey, if you're getting more comfortable uncovering the stories behind the numbers, please like and subscribe. I could easily describe to you a situation that some people might call like a black swan or something, but it doesn't even have to be that dramatic. If a situation occurs in which the group of people who on average win happen to be the people that are using the currencies that do not benefit Interactive Brokers, and all of that happens at once, Interactive Brokers will be put in a position where it either doesn't execute those trades, just halts, which would be a major reputation hit for them, or executes unprofitable trades as a broker. brokerage. Both of those cases are the main risks, as far as I understand, of running a brokerage business. You want to avoid being in a situation where you can't be a brokerage firm, you have to halt trading, or where being a brokerage firm costs you money because they're unprofitable trades. Those are the main risks, and I'm seeing a real tangible threat on the horizon. I don't like it. But at the same time, what must Wall Street be seeing? You have an interest income that is between doubling and tripling in just the last year. It is almost quintupled compared to 2 years ago, and that's almost a triple in profit just for the interest side of their business. Meanwhile, you have the stock trading similar to how it did back in the 2019 period. The market for Interactive Brokers really does seem to think that any day now it could lose all of this heightened activity and return back to the trend line that existed for decades before 2020. But despite that, we're now on year 4 of the number of trades being more than double what it was in 2019. Yes, it's decreasing slightly, but nothing like what people are constantly claiming is about to happen on Wall Street. And you've also had interest rates increase by the largest levels that any of us currently living remember. If that wasn't going to knock this off of the new trend line that has been established since 2020, then I don't know what will. People who have started using brokerages during the pandemic seem to have created real tangible habits and are going to continue to choose that now as a habit rather than replace it with anything else. Sure, it might be largely made up of some sort of gambling. That still provides value to people's lives, and Interactive Brokers does do it really, really well. What Interactive Brokers does not do well is hedge their currency risk appropriately. I'm not sure why they're not taking it more seriously. Clearly, they have better people than me managing and thinking about this, but we do need to figure out whether we're going to approve or reject the suggestion from the Sage Seeds Artificial Intelligence. The suggestion was that this is a very strong buy. I get it. The decades have changed. In the 2020s, people like to trade stocks. People understand what options contracts are. I don't know why Wall Street is ignoring that, but I can tell that they are. And so there is a lot of value here. And so it kind of pains me to say this, but I don't think I can rubber stamp this suggestion. I don't understand enough about currency rates and the hedging strategy that may or may not be too difficult for me to wrap my head around. It feels like it's a really basic currency hedge strategy that really is insignificant. At the end of the day, I'm sure some people are going to make lots of money on this, especially the people who can keep a closer eye and really wrap their heads around the currency risk hedging strategy of Interactive Brokers, or lack thereof. I know a lot of these financial services are very hit or miss. Either you like this sort of annual report or you don't get into it. I do gotta say that this was an interesting little thread that we pulled until we uncovered a potential legitimate risk. Just another day in the office. Don't forget to like and subscribe. Thank you for watching until the end, and I'll see you in the next walkthrough.